All right, folks, welcome to how to pick the best turtle soups. The short answer is time, and that's discussed in SOT. However, you can also determine the best turtle soups by the if-then principle. Which follows a higher time frame order flow. This is a picture which I've posted before. If you've seen it, then observe the finer details. If you haven't, then there you go. Close above equals higher prices. Close below equals low prices. Wick above equals low prices. And wick below equals higher prices. This is on determining the higher time frame order flow. Right, so which means the next candle on the higher time frame, the daily, for example. If today's daily candle closes above yesterday's daily candle, what's going to happen? What's likely going to happen is you're going to have a chance to buy below the open of tomorrow. Right? Close above, higher prices. Close below, lower prices. Wick above, lower prices. Wick below, higher prices. Some intricacies. When the higher time frame is bullish, the lower time frame will explode through the highs. And of course, it'll get an electric shock as soon as it touches the lows and rally. Right? So you'll see it have a touch of a low on the lower time frame and then explode above the highs. And I will illustrate this in a moment. When the higher time frame is bearish, the lower time frame will sink like a rock in the sea. Right? It'll just fall down and down, and you'll buy the low and get wrecked, and you'll buy the other low and get wrecked, and you'll keep buying turtle soups, fake turtle soups, and get wrecked, and blame me for it. No, you're wrong because you didn't know the higher time frame order flow, and you didn't keep it in mind. You were blindly pattern trading turtle soup like an idiot, right? Which is wrong. You should be always monitoring the higher time frame order flow at all times. That's the wise, complete thing to do, right? Because when the higher time frame is bearish, either by closing below or wicking above, right? Then the lower time frame will sink like a rock in the sea. Highs will electrocute price. You'll just have to touch them and sink below the lows. And the lows, of course, will crumble, right? If-then principle, which means if the higher time frame is bearish, then no matter how many bullish PDRAs you draw on the lower time frame, they'll get traded through. Here's an example. This is a weekly chart, and your homework is to know which one it is. Excuse me. We close above, right? This means there's a high chance that the next two candles will give a chance to buy below the open. Right, so close above, wick below, and a massive green candle, an up close candle, right? This means the higher time frame is bullish, right? Let's see what happens in the lower time frame. If the higher time frame is bullish, the lower time frame lows will be used as a launch pad to launch price above the highs on the lower time frame. And if the higher time frame is bullish, then if the higher time frame is bullish, then the lower time frame bullish PDRAs will be disrespected and violated, absolutely ignored, and flipped into support, right? Inverted. So again, this is a key principle. It's crucial. If you're binge watching, then stop and focus, right? If the higher time frame is bullish, then price will fly. No matter what Reaper IFVG you draw, it's not going to work, right? It's going to break through the highs. If you try and sell a bearish turtle soup on the lower time frame and the higher time frame is bullish, you are going to get wrecked, right? Now, and vice versa, of course. Right. This also answers a crucial question, which is, I sold an old high and it kept going higher. Of course, because you were selling the lower time frame during a bullish higher time frame. But how do we determine if it's bullish? Close above, higher prices. Wick below, higher prices. Range taken one side, higher prices. If it's the low taken first, right? It's as simple as that. Key level dynamics. A key level can only be reacted from in three ways: a V shape, an M or W shape, which is the most common and which is the one you look for. This is turtle soup. And of course, multiple touches, which is unfavorable, right? So let's say you draw out the key level. You're really excited, you want to try the concepts. You then draw out the key level, and then it works. It's a V shape, right? This is the higher time frame key level, and this is the lower time frame. It's going to smack into it and abuse the highs. Same here. You were happy, of course. You drew this key level. You bought, it went up. Fantastic. But then, the next day, you marked the key level, and then you sold over here. Great, nice reaction. Let me move my stock to break even. And then it stopped you out, and then it dumped. And you go and punch your screen, right? Because you're pissed. Over here, let's say this was the key level. You bought this turtle soup. Fantastic. Stop break even, and then it smacks back into your stop. And then you buy again, and then it stops you out twice, and then it rallies. Sounds familiar? Probably. Because that's a common mistake of not knowing, of you not focusing on the different types of reactions from a key level. One thing is identifying the key level correctly. Another thing is knowing what it looks like from the key level to your target. Here's a deeper look into turtle soup on the lower time frame. You're going to have the higher time frame key level, and then you're going to have a short-term liquidity pool or pools, the more the better, on the lower time frame. It's going to smack into the previous liquidity pool. Of course, there's going to be a time line over here, vertical line. Smack into it, get everyone bearish, market structure traders selling down here, and it rallies. Now, where can you find the high probability turtle soups? A high probability turtle soup will always be in alignment with the higher time frame candle order flow. Oh, but how do we determine that? Close above, higher prices. Close below, lower prices. Wick above, lower prices. Wick below, higher prices. Take one part of the range, and then take it to the opposing end of the range, and more on that in the next chapter. Right? Will always be fast to accelerate from current price levels at the time. Will always occur at the opening of new candles, not the end of old candles. And this troubleshoots a common mistake and focus over here, which is I bought the turtle soup, but then my turtle soup got turtle souped. Try buying at the opening of new candles, not the end of old candles. It'll always occur at specific times, always, and it will always be a false breakout of a range, every single time. Next up, ICT, turtle soup, all these fancy terms. What's the summary? there is no summary. If you look for a plug and play model, you are a lazy person, and you need to change that, because lazy people don't make it. All right. The only way to get an easy plug and play model is to first put in a lot of work getting wrecked and paying attention to the details. That's the only way. So the only way too easy is hard. Right? Reminds me of the saying. It's an old Chinese saying. It says, bitter now, sweet later. Sweet now, bitter later. But you can kind of summarize ICT in the power of three. Everything you're looking for lies in the open, high, low, and close, or open, low, high, and close. Right? The open on the left side, high, low, and close, open, low, high, close. If you want a summary of ICT, it's buy below the opening price. This is the foundation. Buy below the opening price when bullish, sell above the opening price when bearish. All concepts are subservient to the open, high, low, and close. You look for the breakers above the opening price. You look for the bullish order blocks below the opening price, etc. Every bullish turtle soup, and this one is food for thought, every bullish turtle soup that has ever happened below the opening price of the candle. Every bearish turtle soup that ever happened above the opening price of the candle. A deeper dissection of the open, high, low, and close. There are 3 trades per candle, right? And this is a fixed, repeatable phenomenon. If I show this to a 5-year-old, he'll get it, right? Every candle has an open, a high, a low, and a close, or low, high, low, open, low, high, and close. Excuse me. Right? That's a fact, and you can see it every single day, every single candle. And I mentioned on Twitter that the moment it clicked for me was when I discovered, and when it came to light, that every single candle has its own PO3. The 1-minute candle has PO3, the 5-minute candle, 15, 30, 1 hour, 2 hour, 3 hour, 4 hour, 1 day, weekly, monthly. They all have their own PO3, and you can play with them however you like. And me mentioning that should make it click for you, because that's all there is to it. Open, high, low, and close. Power of 3. Buy below the open when bullish. Buy below the open bullish, and sell above the open when bearish. How do you determine? By the closes. Close above higher prices, close below lower prices, wick below higher prices, wick above lower prices. Of course, every candle you get the open, the low, OTE, high close. London, New York, whatever, all those names are a depiction of this open, high, low, close, OTE. New York, quote unquote. So what ICT did was he branded this, which this concept is old as the hell. It's not something new. It was first introduced by Larry Williams. Right? I suspect he took it from someone else. But the concept is new. It's not new. Excuse me. Right? Open, low, high, close. And a book I recommend is Long-Term Secrets to Short-Term Trading by Larry Williams. It's a good book. But that's it. Asian session, quote unquote. The names are just the names are a good way to get people together, because signs and symbols and names of brands rule the world. So if you tell the people it's New York, right, it makes more sense than telling them that it's the second trade of every candle. I bet that's what it is. This is another concept which I made public, which I never intended to. The elements of a high probability trade setup. A higher time frame key level, manipulation time, and pre-manipulation liquidity pool. And it's the smallest for a reason, right? It's least important. Here's a picture I repeat, and I try to repeat this as many times as possible without causing it to be annoying. But this is crucial, right? Plan the higher time frame key level, mark the manipulation time, what is this manipulation time? It's London, it's midnight New York, it's the 9 a.m. candle, it's the opening price of whatever candle you're trying to turtle soup to the opposing end of the range. It's that simple. Lose sleep over this picture. Think about it. Right? Truly delve deep into it. Again, in summary, you buy below the opening price when bullish. You look for your pattern here, OB, FVG, breaker, SMT, whatever, right? Over here. And vice versa. This is a bullish candle. So if you're expecting price to go higher because we closed above a candle, then you look for this. Buy below the open. Look for whatever entry pattern above or below the opening price. Derive the bias from the higher time frame, either the closes or the range. So if the higher time frame closes above, then you look for price to dump below the open and rally, and vice versa. Open key level rally, open key level rally. Backtest this because the way to learn is to backtest, confirm the theory, and then forward test. Right, those 3 steps. Write that down. Backtest, confirm theory, forward test. Backtest this on every single time frame, all candles, and thank me later. All the focus on the daily and weekly range to keep your sanity. How do you apply all that into trading? Well, that's a discussion of the next episode. I hope you found this insightful. I wish you good luck, good trading, and see you in the next one.